right. Cheers and welcome to the Happy Hour Money Podcast. That is a mouthful.
Still getting the title down from that standpoint. But yeah, Happy Hour Money Podcast. I think we got it right.
Close enough.
We'll get it right eventually.
Yeah, exactly. But so today, topic, we kind of touched on it in our first intro podcast, but basically we want to take a look at some closely held beliefs when it comes to investing. And one of those is just the simple idea of diversification, but through what's called modern portfolio theory, which is more commonly known as like 60-40 portfolio, or 60% stocks, 40% bonds, or hey, if I just throw in different asset classes like international stocks, I'm diversified. And if you want to take more risk, you have more stocks. And if you want to take less risk, you have more bonds. And if you're over the age of 65, you should have a more conservative portfolio. So these are all different vernacular, different kind of stories or anecdotes around this idea of what's boils back down to kind of one, like Frank called a philosophical white paper called Modern Portfolio Theory. So we're going to talk about that whole concept today, how it's used in the world, is it still relevant, and kind of just break it down and see if this is a good way for investors to invest their money.
Yeah, and there's some other different tangents we can get into, which is just the idea of most U.S. investors have something that's called like a market cap weighted index approach, which is literally just looking at the amount of dollars that are in the market cap of a certain security. So like Amazon would have a bigger weighting than Berry Plastics, right? So the idea of if you have an S&P 500, you're going to weight it to the biggest names. And there's a lot of interesting research there as well as to why did that happen? How was that selected historically? And it doesn't actually make sense. So those would all be kind of areas to kick things off and chat on. But yeah, when you think about a 60-40 portfolio, there's a fairly well-known, and we'll reference, so for those that aren't familiar, when I say FinTwit, that's just like financial Twitter. There's a person that is on FinTwit that I have a screenshot, because I take screenshots so I can have receipts, but because people delete stuff, right? It was, 60-40 portfolio is the best you can do. And that was a claim made in 2019 that he feels that's the only way that it can be done. Anything over and above that, it's a fool's errand, why try? All those different things, right? And everyone's entitled to their opinion, but it's interesting that there's really not any academic evidence that says that is the right portfolio. It's like, hey, this has worked and worked well. Well, part of the reason that it's worked well is you're looking at it in a period of time where we're coming off of 12 to 13 years of really good U.S. market, where if you're U.S. heavy in stocks and bonds, you've done awesome. And then also more of like this longer super cycle where early 80s, you had interest rates that were 10-year treasury bond, U.S. treasury bonds, which are kind of the risk-free or this like best debt you can have in the world, somewhere around close to 16%, and it's fallen to where it's now about 2 3/4. Well, that's really good for bond prices. Falling interest rates, low inflation, all good things for bonds, alongside having stocks do really well. So like that combination has been deadly for quite a while. The average financial advisor has grown up in that world. There's not a lot of people that were working with clients and managing money that are still around that were there in the early 80s, late 70s. Like that's just not the world that they've grown up in. So the 60-40 is kind of dominated from that standpoint because it's worked, it's easy to sell. Hey, there's this thing, this is why it works, and we can do it at really low cost. And I think that's what kind of a lot of robos have attached themselves to. A lot of just bigger institutions, it's like, hey, from a compliance standpoint, stick to this, it's worked, don't deviate because you're gonna have clients fire you.
Yeah. And I think we can definitely dive into more of the weeds on kind of things you just chatted through, but I think it's even worth kind of going back and take a look at really what is modern portfolio theory and why has it grown to the level that it's grown. So like in a nutshell, modern portfolio theory is basically this concept of you can manage risk in your portfolio by having different asset classes, with the idea that like some assets move up and down a lot, some not so much, and theoretically, uncorrelated assets, they sort of counterbalance each other. So when stocks are doing well, theoretically bonds are just staying stable or whatever. But when bonds or stocks are doing terribly, you have the counterbalance of the bonds to keep your portfolio overall doing better. And then as you increase the risk assets, you can kind of follow this risk frontier.
The efficient frontier.
The efficient frontier, thank you. That and gradually just increase your risk in this nice, neat little line, right? What we know is that that's obviously not the case for life, but why is this kind of the foremost, investment ideology now? And my belief is that basically it's because it's very sellable and it's very easy to understand. Where like, hey, I say, hey, don't put all your eggs in one basket, and you're more likely to have a better portfolio by doing that. And you're young, you should take more risk. You're old, you should take less risk. And you just move your little neat portfolio down this line.
What is risk though? And I think that has to be the question that's asked, right? Like, what is risk? Because if you think about it, there's a risk of failing fast, there's a risk of failing slow. And at the end of the day, and we'll talk on a specific podcast on inflation too, at some point, but what are real returns after taxes, fees, and inflation? Like net after everything, what do I actually have left? And am I increasing purchasing power or am I losing purchasing power? At the end of the day, that's it. Like that's why you would ever want to put money at risk.
Yeah, absolutely. And when we look at investments, one of the things that you kind of need to understand is like, a lot of people out there, don't understand what options are available. That we have these trillion-dollar powerhouse firms that are basically saying, oh yeah, just put all your eggs in one basket. Yeah, it's a story we can relate to, and therefore you've seen the growth of portfolios with modern portfolio theory, whether it's the best way or not, just because it's very sellable, very easy to grow a firm around it. And in the actuality, like I have this conversation with clients all the time where, like, should I invest in use Schwab, should I use Wealthfront or Betterment? And they're all the exact same. And there's a lot of studies that actually show, like, one I really liked was I think my favorite did, if I remember correctly, but basically it showed like all these different asset allocations under modern portfolio theory, like even like something like the Bible. But basically, no matter how you did it, like over time, they all kind of end up in the exact same space. So really, like to your point, the only thing that matters is indexing and keeping costs low and just sticking to it. Which again, theoretically is a very easy way to make money. We obviously know in actuality none of this is true, but that's kind of the background of what modern portfolio theory is and why we're going to have this conversation in the first place on it. But let's dive deeper and kind of under the surface of like why do we disagree with modern portfolio theory? What are some flaws there? As I just looked at some of them, but let's kind of peel back the onion. So if I'm an investor today, why would I not use a Robo advisor? Why would I not use a more typical portfolio? Like, why is that not necessarily the best option for me?
So a lot of times, and there's even tools that advisors use where one of my biggest pushbacks, one of the different tools that was out there, which is it's called Riskalyze, I'll use their name. They take data, but it's going back to 2000 to score investments. And it's like, well, we haven't had a high inflation environment since 2000. So like, how are you building your whole entire business measuring risk using data that only goes back now 22 years? At the time it was 19 years. But it's because leveraging and sourcing that data is expensive. And so for a lot of firms, they're going to say, hey, let's look at a snapshot of doing X, Y, and Z. And they're going to take that. And so for a lot of robo advisors, what they've done is, again, going back to what I talked about earlier, they build everything on, hey, the last 40 years, the last 30 years, the last 20 years, these are things that work. These are things that are lower cost. These are things where we can get people invested. And again, part of what Josh has talked about is having an investment strategy and sticking to it. Part of that is key. And so it's like, if you're going to buy into this and believe it, it's still better than doing nothing, right? Like full transparency. If you decide to do something and you are like, hey, come hell or high water, I'm going to do this, it's still going to be better than if you're wishy-washy and changing all the time. But like to understand why it works, the idea around the 60-40 portfolio is that, yeah, when stocks do bad, bonds are kind of the ballast to that. Well, we haven't had a period where we've had rising interest rates over a period of time with inflation, which is what we've seen over the last, call it, 12 to 18 months, where we're at all-time highs in inflation over the past 40 years. And so when you think about what does a 1% increase in interest rates do on the bond side of a portfolio? So the aggregate bond index, the U.S. aggregate bond index, is what probably most people have their money in today. And if you think about that's the bulk of your portfolio, whether it's 401k or in a robo advisor, it's It's like if you take a 1% increase in interest rates, so if it goes from 2% to 3%, right? That's bad for bond prices because all bonds are issued at par, so call it $100. And then from there, they're going to pay you a fixed amount every single year. And then the best case scenario is you make that every single year and you get your money back if you hold the bond through maturity. Most people are going to own a bond in an ETF or a mutual fund. They're actually going to go out and source the bond individually. So a little bit that's done for you, but it's like that 1% increase, right? Where today the aggregate bond index is just under 2%. That 1% increase is a negative 3% total return. So that takes an entire year's worth of income plus about half a year of income moving forward. So like that's a negative impact already. And we're not even looking at what is considered real return. So like what's inflation in that environment? Well, inflation is somewhere, according to CPI, somewhere in the 8s. We'll have a whole conversation on why the CPI is complete bullshit as well later on. But the idea that works in that when stocks do bad, bonds do good and vice versa. This year, 2022 is a great example of that where they've gone down together in unison. And they've offered zero diversification benefit because bonds have done bad. Wall Street Journal in the first quarter had their headline, worst quarter for bonds in a decade or in decades or whatever. And like that's the front page of the Wall Street Journal. But I was told bonds were my safe money. So like how did those go down when bonds went down or when stocks went down? And so I think that's what a lot of people are going to come to grips with is like understanding how do these things actually structurally work together and what are they doing? Because for so long, they've just been this nice pair that's worked together. And to me, that is absolutely something that needs to be understood. The other thing to think about, and this is actually just some fun little trivia. So Deutsche Bank did a look back of 10-year treasury bonds, which again, there's going to be some of those in an aggregate bond index where U.S. treasuries are part of it. 10-year is the one that everyone focuses on so much. But they look back in history and they had to use some proxies pre-1941, but they went back all the way to like the 1700s or something like that, late 1700s. 10-year treasury bonds had the worst start through April ever on record, which is wild. That is wild. And that doesn't usually bode well into the future. Where I've seen, again, people say, well, a patient bond investor just holds through this. Fair. Maybe you do just continue to hold through this if you are firm in believing that you think interest rates will continue to go down. So interest rates were at 16%. Interest rates now are just a touch below 3. Okay, so are they going to go to 0? Okay, there's a little bit of margin there. Are they going to go negative? Because that's the bet you're making. And if you think that that's going to be true, I also have oceanfront property for you in Arizona. Like, are you willing to buy that? It's like, come on, this is ridiculous. And then if you also look at just 10-year treasury bonds from 1941 to 1981, they had a negative real return because inflation was higher. And so you might feel safe saying, hey, I put in my $10,000, I get my $10,000 back out. What is that $10,000 buying you? And if you look from basically the end of World War II for a 10-year period after that, you put in $10,000 into treasury bonds, you got about $6,600 at the end of that in purchasing power after getting paid income. You got all your money back because the government didn't default. But it's like, what are you actually being able to buy for it? And like, that is still kind of that losing slow mentality, but it feels better, right? Because I didn't see the negative red on my screen. And I think that's where people need to rewire their brain and never had to really deal with that. But the last 40 years and the next 40 years are going to be very, very different. I think a lot of investors aren't prepared for that.
Yeah, I absolutely agree. And I mean, even if you kind of peel back the skin on this, not a lot of data to sort of support this, but if we think anecdotally about even just the creation of modern portfolio theory and where the world has changed since then. I mean, when this was created back in the 1950s, we were 10 years out of World War II.
We're still on gold standard.
Yeah, still on gold standard.
Quasi.
And there was very, very minimal globalization, if any, as part of the repercussions of World War II, right? Since then, we've had massive globalization. We've had, the U.S. dollar has been the world reserve currency and has gone off the gold currency or gold standard. And so you have a lot of things that have drastically changed over the past 70 years. But if we look at like McDonald's, it gets 50% of its revenue from abroad, 50% of its revenue internally. And there's a bunch of them like that, like KFC, whatever.
Microsoft just came out and talked about they have a ton of revenue outside of the United States, and the dollar is so strong that they had basically FX or currency write-offs. They had a ton of issues with that.
Yeah.
And so they just came out and you're going to see that.
Yeah, absolutely. But so like this, I think actually though creates another inherent flaw in modern portfolio theory, where like so obviously the definition of risk in modern portfolio theory is loose at best, right? We just kind of showed that with the bond, which is your safe investment in the spectrum, is can be non-existent for decades on end as a safe investment or safer investment even. But also, like along that lines, you have scenarios where, like modern portfolio theory, one of the ways it calculates risk and why bonds typically are deemed less risky is because it goes on what's called variance, which is basically the ups and downs of an asset class. So how often or how big are the swings within the market, right? So problem with that though is you have similar variance mathematically of one that just goes up and down 10% frequently. You have the same variance as a portfolio that goes down epically every now and then. And so with this globalization and kind of the way the world has changed, one, it creates more opportunity for black swan events where things that can just be incredibly detrimental to a portfolio and cause those 90% drops are much more realistic. I think we're actually seeing a lot of this. Like Ray Dalio has done a bunch of research in his new book, Principles for Changing World Order, and he has a lot of this research at like economicprinciples.com. But there's some fascinating research on like world super cycles, and I think we're at the precipice of a lot of different super cycles. But with that too, like you see a situation where like we're actually kind of seeing this unfold. I think right now, where the U.S. dollar is on the verge of potential collapse, or if nothing else, losing its spot as the world reserve currency.
Call you Jack Dorsey, right?
Yeah. I mean, like even like one of our biggest allies, Israel, basically delinked the dollar from their reserves and chose the Chinese yuan instead. But also, I mean, if you look at a situation where you're focused on kind of just the 60-40 portfolio, well, what happens in a scenario where China all of a sudden shuts its borders and a lot of the U.S. stock market gets their revenues, like Apple, Google, KFC, all these companies that we've talked about get a huge chunk of the revenues from China, but also, China has a huge impact on our bond and our treasury bonds, as well as our dollar value, just because of being essentially debt purchasers over there. And they've deleveraged from U.S. for, I have my tinfoil hat theory reasons, but this creates to me a huge flaw in modern portfolio theory, where what's the hedge against the 90% collapse in modern portfolio theory? And I would argue there is none. And because the past two crashes that we've seen, you start to see massive correlation amongst those traditional asset classes that are held in there, and so you're getting nothing. You're getting no protection.
Yeah, it's a liquidity and flows game, and I think for those that really want to dive into the weeds, and he's much more articulate and way more research than both Josh and I. Mike Green's talked a lot about this specific topic of, hey, the rise of passive investing, the 60-40 portfolio, these different things. Again, when the times are good and flows are strong, so you have people saving in their 401ks, you have people that are saving the excess cash, like it all is flowing in the same direction, and it pushes those assets up higher, which again, if you look at the way that like the S&P 500 is constructed, it's a market cap weighted index. So the names at the top get more of the flow of money. So the Amazon, the Netflix, the Googles, the Microsofts, the others, like those are all going to get more flows. So more money that comes in, those names get bigger. That just perpetuates the growth of the index, which works. But if you go back in history and try to understand, like, why did the market cap index get selected? And you go back to the 50s and 60s, they wanted to do equal weight, where everything kind of gets an equal weight. Hey, we're going to pick 500 companies, they're all going to get the same equal weight. The challenge was they didn't have the computing power then. So like, well, it's easier to do mathematical calculation like this. It's easy. So let's do it this way. Wisdom Tree put out a really good piece on this and kind of looking deep into the history, which we can link in the show notes to read. And I think it's important to understand that. Now, even saying that, right? Like looking at an equal weight S&P 500 index, it's had times where it's much better and much worse, but at least it doesn't overweight, and it's going to own a lot more of the things at the top, because typically what happens is you get overvalue, the crash, and then you see everything seep out of that. But there was another good piece of research. I think it was from somewhere over in the UK at one of the different colleges, but it basically made the joke that monkeys throwing darts could pick a better index weighting methodology than market cap weighting. And there was all kinds of other different pieces of research. And it's from like 2015 or 2016. I'd have to really search to find it, but I have it, I'm sure, somewhere. But it's just fascinating to see that, like, it's illogical that you have so much money that goes into this because of it's just kind of the de facto default. And so people just look at it and say, yep, that's what we do. That's what it has to be. And they don't actually question, like, well, how did we get here? And I think people are going to start to be forced to kind of wake up to that a little bit. And then going back to the dollar piece, you're speaking my language, so anyone who listened to the first episode, there's a reason why I talk about Bitcoin, but I'm not going to go Bitcoin right now. But the global reserves, so basically everywhere around the globe functions on the US dollar standard because the dollar drives the world, where the US now, we don't make anything in the United States. What we do is we export dollars to the world. We have some tech, and we do financial services. We don't really create anything. We import everything from like other countries that are lower cost producers. But if you look at who holds global reserves, at the max, I think it was like 73 or 74% of central banks held US treasuries. So like they were taking, excess surpluses. So if I'm a family household, I'm storing my excess in my emergency savings at the bank in dollars. Well, these sovereign countries were basically storing it in US treasury bonds. And it was at a peak like 73, 74%. Well, that's down to 59. Now, again, not necessarily need to focus on the fact that it's down. It's the velocity of the change of how much it's come down. And it's been very drastic. And you look at other countries around the world, there are countries that you may not like that are using and having more natural resources that they have, and then saying, okay, we're going to start to have more gold and been active gold buyers. And I think those are type of things that it's like we're moving into an environment where hard assets, for the first time in a long time, are starting to become something that you want to see. And 2020 is a good example. You look at the S&P and you look at bonds, both down, commodities are up over 30%. If you look at a 10-year return of commodities, they're still negative. Like, it's crazy how horrible commodities have been for a long time. But at the end of the day, when it's like you need these things to structurally produce materials and run the world, and when they're in scarce supply and all of a sudden supply chains are screwed, you're seeing the pressures, and all of a sudden these prices are just exploding. So all that to be said, like, we have a 60-40 portfolio. And I hear you, Josh, I hear you, Isaiah, there's something wrong. What do I do to fix it? I think that's the natural question. If I'm a listener or someone watching, I'm saying, okay, it's great. You've explained to me that this house is on fire. How do I put it out? Like, I got a fire extinguisher. I need more. So, like, what do you think? How do you complement that?
Yeah, and I think that's the $1 million question, right? And we obviously have our theories and stuff, and I think there are some good aspects of modern portfolio theory that I think are worth keeping as part of the ingredient mix, if that makes sense. Like diversification, I think you'd have to be an idiot to disagree with has its benefits. Not putting all your eggs in one basket for the average investor. Yeah, it's a good idea. The problem with modern portfolio theory is they're choosing the wrong eggs, right? So one thing investors can do is really focus on, all right, what are the risks I'm preventing or protecting against, which, frankly, there are a lot of different ones all coming against you at the same time. So the diversification you're really looking for is, all right, how do I protect against as many risks as possible, not just volatility? Because like we've already talked about, like, okay, inflation risk, drawdown risk, all these other factors. So, like, for example, to prevent against drawdown risk, like, this isn't necessarily a asset class, but this is something we do when we invest, is we use things like momentum investing, which use essentially rule-based math to determine when to get out of an asset class. So if stocks are not doing well, you just get out of them. And then you prevent the massive drawdown. So in those black swan events, the math would tell you, get out. And so you're not subject to them, right? Then, another way of sort of diversifying is, again, let's say inflation is the risk we're diversifying. Okay, well, let's look at inflation for its own risk merits and then find asset classes that do well in inflationary environments. Like ones we love are like Bitcoin, gold, farmland, rental real estate, things like that. Like, so, and then, obviously each of those asset classes have different components. You can, weigh the merits against other risks. And, ultimately, when you start to see all these different factors coming together, you start to have a diversified portfolio similar to modern portfolio theory. It's just not necessarily held in the same vein, if that makes sense.
Well, and most investors are kind of typically positioned for the environment that they've been in, not the environment that is to come. And so there's a really good chart from Resolve Asset Management that we use a lot of times in conversations around investing, which is, there's really 4 different market environments. There's two different kind of categories. There's rising inflation, lowering inflation. Feel pretty confident we're at the rising inflation at 40-year high, so I feel pretty comfortable saying that. And you have a growing economy or a slowing economy. And so you have inflationary stagnation. So that's last time we saw that. I think we're there now, but that's my opinion. Late 70s, early 80s, gas lines. What you see is basically wages are not increasing with the rate of prices. And so people feel like, hey, I feel poorer. I don't have as much to spend. There's issues. I can't get the stuff that I wanted to get. Sounds kind of eerily familiar with where we're at right now. Then there is the kind of inflationary boom, which is last time we saw that was like 2002 to 2007. It was all about the BRICS. Brazil, Russia, India, China. They're going to take over the world. The U.S. is done. You got to own things outside the United States. That was kind of their heyday, where you see high growth, but you also need like the inflation is higher, so commodities working, and these producers of those materials to like make stuff. And then you have the disinflationary bust. That is the great financial crisis. That is the 2 months with COVID. That is .com, where the air gets sucked out of the room. Everyone goes, oh shit, maybe I have too much risk, or I don't have enough liquidity, or there's these different issues. And then there is the disinflationary boom, which has been where we've been from a United States standpoint since about 2009, outside of that little quick blip of COVID. And maybe you talk about 2018 with a little wobble, but basically it's risk on for U.S. stocks, bonds, and real estate. So most investors, if you look at portfolios all the time for people that are coming in, it's like, hey, I own 70 to 90% US, and then it's going to be some blend of stocks and bonds, but a lot of them are 80, 90% stocks because they are younger. Like we typically lean towards a younger audience. But again, are you compensated for that risk? You just came off a 10-year period where you made 14.5% annualized. The compound annual growth rate for the S&P 500 historically is somewhere between 6 and 12. You've just been at the high band of that. Really hard to then say, hey, the next 10 years are going to be exactly the same. Copy and paste, let's go. It doesn't work that way, right? You had from 2000 to 2009, the U.S. stock market was annualizing negative 1%. Could we see that again? Hell yeah, we could. Like, we don't know. And the future's unknown. I think that's going back to what you're talking about is like, yeah, the idea of diversification is you need structural diversification that works in those different environments. U.S. stocks and bonds only work really well in that disinflationary boom. That's where they work really well. Now, again, each of those different environments aren't going to be nice 25% increments where they move and it's like a clock. We know it goes from here to here. We just allocate. It's like they can bounce around and you don't always know where you're at. And so, yeah, investing gets tricky and it gets difficult, but it's like you want as many different ingredients, and we use that term a lot. Like if I'm going to use a cooking analogy, I want all the ingredients to make my meal. Instead of having like, hey, I have a cupboard of 3 things, good luck, make something tasty and delicious and nutritious. Versus saying, hey, I have the cupboard full, I have the fridge full, I can pull out what I want. I think that's ultimately what investors want. It's like survive and advance. Think about like the March Madness tournament, right? You want to survive and advance. You don't play your best game. You just can't get wiped out. I think a lot of people, going back to our intro conversation with Robinhood, they get to the point where they, hey, doing awesome, and they get wiped out. Or they're changing into now something different. It's like, okay, look at what you've actually done. You've done next to nothing, and your returns are not, you're not getting compensated for the risk that you're taking. I think that's ultimately what people need to understand. And it's going to be different for everyone. What's your line of work? How consistent is your income? You have a spouse, doing your home, like all the different things that are out there. There's no, hey, you need to invest in 1, 2, 3, 4, 5 things and in these weights, and that's what's right for everyone. It's like, no, you got to understand kind of what are the other circumstances that surround that person.
Yeah, and I think that's where it really boils down to, because I know a lot of things you're saying just sound like diversification, just the same way you would hear it with modern portfolio theory. But I think the big differentiator here is diversifying against more risks other than just volatility. Volatility is just kind of an inherent component of all investments, period, right? But
volatility cuts both ways. People are never mad when volatility is high, but it's going up, right? Yeah. That's a good time.
Yeah, but one of the things, we talk about too is like and one of the reasons for this is like the biggest thing you're overcoming is losses, whether that's loss from inflation, loss from volatility, or any of these different things, but losses are exponential. And if you go down, say 10% of portfolio, it only takes you about 11% to get back to break even. So you go that from $100, you go to $90 or so, you have to make $11 to get back to that 100, right?
So not a long time digging out of that hole. Whereas if you go down 50%, so now you have $50, well, to make $50 again, I have to double my money, so it's 100% return. But if we kind of break that down, the average stock market returns over 10 years or per year is 10%. Well, if you go down $50 and you gain 100, that's a 10-year recovery under the average. So you're spending 10 years just digging out of a hole. Well, if you minimize those losses, you don't need to make as much money, so you don't need as much volatility to the upside to have a successful and build sustainable wealth. And that's kind of when we talk about sustainable and become wealthy, not rich, is because these things are sustainable. You don't want to be digging out of a hole. You want to be creating, building new wealth that stays, right? And so these are some of the things that really understanding where the risk is coming from in your portfolio, or where the risks have been in history. And like Isaiah was talking about, like 4 different environments. It's not that hard to build a portfolio that can basically do well under, at least decently under, any of those different environments. That's something that we've been working hard at the past 2 years together, and several years prior to us being together and stuff. But yeah, so from a diversification standpoint, it's really diversifying your portfolio against as many risks as possible in your portfolio to minimize losses and to spend more time actually creating wealth. And that's where you have to, it is work. Like, this is why, frankly, a lot of people just stick it in a Robo instead, because understanding what the components of real, rental property versus farmland versus, managed futures, it's not something easy. Like, it took us a lot of research to learn ourselves. But if you want to, again, build real wealth and not be subject to these ups and downs, that's ultimately what you have to do.
Yeah, and I think it's like one of those things, depending on what your skill set is, you can see something very quickly and be like, oh yeah, that's there. When a novice, it takes them that would take a long time to see it. But as you get more into this, you can look at a Robo allocation and be like, yeah, this is all still one bet. This is a bet on the U.S. stock market doing well. And it's like, well, I have 25 different ETFs. It's like, yeah, but it's still one bet. And the goal is you want to have something that can thrive or at least survive and do decent. Because for most people, right, they're going to be continuing to add money to those accounts typically, right? I think if you're watching or listening to this, you're probably in that camp. And if you are at retirement, it's like, yeah, shoot, the first 5 years before you retire and the 5 years right after, that's the most critical. You can't have that huge drawdown because that's when you're going to start taking that money out. You can't go just make more. Where as someone that's younger, it's like, yes, you can take more risk because you have the capacity to take risks. There's 2 different risks. There's risk tolerance and risk capacity. Tolerance is, how do I feel? Can I sleep well at night? Am I going to be too nervous? Capacity is, how long before I need this money? So yeah, there can be time when you can, give yourself the ability to take on more risk. But I think so many people fall into the trap of, well, then I should just be 100%, yes, be 500. And it's like, well, but the math doesn't work as well. If you're going to be a longer term investor, you know that will not always be the most efficient thing. So why wouldn't you want to say, hey, if I have 30, 40 years, I want these different ingredients that are going to work well together to where it actually compounds much, much better when I'm adding to it. And I just think that's lost in so many people. And it's hard to sit down and see that, but it's like the math holds true if you want to run the numbers. The diversification is going to be, I'm always thinking, shoot, I should have done this other thing, put it all there. And then you're going to say, shoot, darn it, I should have put it all there. Instead of maybe 1 year you're a hero and the next year you're a villain. And that's kind of what a lot of people are at. It's like, U.S. stock market is great, hero. If it does bad, villain, what's going on.
Yeah, and I always find a sort of fallacy within our the markets and kind of conversation too of around these things like, oh yeah, young have the capacity to take risk. Yeah, you might, but at the same time, why? Yes, take risks, but take different risks than just investment risks like this in terms of a portfolio. Yeah, if you want to go start a business, things like that, 100% support that. But when just by investing more aggressively, using that analogy I just mentioned, that 50% of loss is a 10-year recovery potentially. Well, you may be young now, but by the time you recover and actually start making money again, you're not.
Yeah. Life changes too.
Yeah. And so like, why not spend that 10 years actually building wealth, albeit potentially slower, but you're still building wealth that's sustainable and you're not digging out of a hole. So just because you can take certain types of risk doesn't mean you should. And
if you can be opportunistic when everyone else literally has nothing to, like, where they're in those huge drawdowns and you're not, you can be opportunistic when others aren't. And that sounds, maybe bad to some, but that's literally what you want to be. You're in a position to be buying that weakness. So case in point, real estate market is insane right now. But let's say you had invested and you don't have the 30, 40, 50% drawdown and you're like hand down 10, real estate's really on sale, but no one can buy it right now because no one has any liquidity. Oh wait, I do because I didn't take a bunch of risk in my stock only portfolio. Boom, now you can move into those other asset classes at a period where someone's a forced seller and you can be like, yeah, I'll buy that for 75 cents on the dollar. That's cool.
Yeah. And something you brought up an interesting topic too of like being some years like by doing it this way, some years you'll be the hero, some years you'll be the villain. Well, when it comes to investing, like if you, as bad as it's going to sound, if you feel like you can contribute to conversations about investing at tables with your friends who know nothing about investing, you're doing it wrong. Like the example I would use, like I hear people talking all the time about, oh, I'm going to invest in Tesla, I'm going to invest in these things, and people then buy Tesla because they're talking about it with their friends or whatever. That's the stupidest way to invest any human could possibly do because 99% of people are not good investors. If you're hearing it from your friends and things like that, guarantee they have just heard it from some other random schmo who doesn't know what they're talking about. And so that's where you want to be in a situation where you frankly can't add anything to a conversation of that nature because, hey, you're just building wealth. You're not trying to get rich and gamble on these different stocks. And so I think that's a hard thing for people to do because they want to be part of the tribe. They want to be part of the herd and they want to be able to contribute to those conversations. But, freedom and some of the other things that come with actually having the money, to me should, and I think for most people would agree that far outweighs, one dinner conversation.
Yeah, unless it is your profession. And even then, you look at some of the hedge fund returns this year, holy smokes, they're going to crush. Because a lot of them are over levered to technology names. But it's like, unless that's your day job and that's what you're doing and you are paid and paid well to do it, yeah, you're probably not going to know anything that the market doesn't already know about stock X, Y, and Z, unless you're playing in like the micro cap space and you're really doing due diligence. But micro cap also can be quasi penny stocks, but there can be good businesses there if you know what you're doing. But again, like at that point, you have to put in the work to do it, and that there are some differences there. But yeah, you're not going to know anything about Tesla that's not already known. Like you didn't read some Reddit forum that no one else is seeing, right? It's all public information. I think that's a tricky thing where so many people think about security selection. So I'm going to pick Tesla over Amazon and that's going to give me better return versus asset allocation versus stocks versus real estate or stocks versus commodities. And there's a really good story in a paper that I read. It's a couple years old. It might be from like 2017, but it was basically the best emerging markets manager. So the person that was the absolute best in the world at running money in emerging markets, which would be Southeast Asia, Latin America, and Eastern Europe. Number one out of everyone else in the world, still underperformed from a percentage returns perspective than the person that was dead last, worst performer of U.S. large cap managers. So the person that was the worst at their job still outperformed, right, dollars and cents, the person that was the best at their job in emerging markets. So the idea and the thing that I would try to share with you would be, the tallest, strongest tree in the burning forest still burns. It doesn't work. So if you're in the wrong spot, even if you have the best name, like you're still going to get hit. And I think a lot of times it's like, what asset class do I want to be in? And that's where going back to kind of the framework of the 4 different market environments helps. You think about, okay, higher inflation, lower inflation, growing economy, slowing economy. If you get those things right, big picture, then you can kind of figure out what things need to be positioned where. And I think that's helpful.
Yeah, for sure. Well, any parting words of wisdom that you want to impart before we can sort of close the chapter on portfolio theory bashing?
You can take a 60-40 portfolio and add other different pieces, 5-10% weightings, and all of a sudden it looks a heck of a lot better. And so I would just say, run the numbers, look at what it is. And, it doesn't have to outperform over a 3 or 4 or 5 year time frame. A lot of times it's like, okay, I'm structurally going to own these things because I'm a long-term investor. And I think if you're a long-term investor, you should want to have a better diversification. I think that's the biggest thing that I see that you can understand.
Yeah, or as we would say, real diversification, not
Structural. Yeah, things that truly are going to work in different environments better.
Yeah. Awesome. Well, thank you for listening to us this long. Cheers until the next time.
Thanks for listening to today's show. The comments made on the show should not be taken as investment, tax, or legal advice. All comments are for educational purposes only, and you should talk to your professional team before implementing any of these strategies. Josh Bennett and Isaiah Douglass are partners at Vincere Wealth Management. Vincere Wealth is a registered investment advisor with the U.S. Securities and Exchange Commission. The biggest compliment you can give us is to share this content with your friends and family. Reviews help our show to get found, and Apple Podcasts is the platform that is predominantly how people listen to this show. If you have 3 minutes and you love the show, head over to Apple Podcasts and give us an honest review and rating. We'd greatly appreciate it, and that will help people find this show. Also hit subscribe on the YouTube channel so that way you don't miss any of these episodes. For all today's links and information, head over to the happyhourmoneypodcast.com. Thanks for listening, and we'll be talking to you again here soon.